You're not actually giving them money, you're giving them an opportunity. What you're really giving them is a portion of the loan. So rather than saving 10% or 20% deposit and then borrowing 80%, they're using your 20% plus 5 for the stamp duty, and then they're borrowing 80.
Hey, welcome to the show, Leading and Growing Your Real Estate Business. This is Coach James Short, aka Shorty. And this is a show for those within the real estate industry wanting to lead and grow their real estate business. It's a series of interviews that we conduct for those within the industry. So we're finding out what those leaders are within the industry, what makes them tick, what's their story, what are their strategies, and how to become the leaders and the growers within the industry. But also it's an interview series with those outside of the industry. I'm always a big believer of looking at a whole different part of the pie rather than just focusing on one part of the pie. Because what it does, it allows you to have a different perspective, allows you to get snippets or golden nuggets from those outside of the industry that can look in the industry and go, there's a different perspective. And so I encourage you to reach out to the guests. I encourage you to lean into these series to find out how can these pieces of information, experiences, stories help you lead and grow your real estate business. Welcome back to another edition, and we are excited to have this amazing guest back on the show, Cate Bakos, buyer agent and property investor from Cate Bakos Property. Experienced team of buyers advocates is dedicated to providing tailored property acquisition services in Melbourne and selected Victoria regions. Based in Melbourne's inner west, they specialize in guiding clients through every step of the property buying process, from strategy to settlement. Their diverse backgrounds and deep knowledge of the Victorian real estate market ensure you get the best possible advice. Whether you're purchasing a home or an investment property, trusting their team of property advocates to help you make informed, confident decisions in Melbourne, Ballarat, Geelong's competitive markets. As a trusted property advocates in both Melbourne and selected Victoria regions, they specialise in assisting clients through the entire property buying process, from strategic planning to final settlement. Their deep understanding of Victoria's real estate market and knowledge of various neighbourhoods ensures that you make confident and informed decisions, whether you're purchasing a home or an investment property. Looking forward to unpacking some key areas around long-term strategies and getting started early, how we can help our kids into property, which I'm looking forward to, and the truth about off markets. Cate, super honoured, super privileged to have you back on the show. Thanks for joining us.
Stop it. It's great. I'm the privileged one. I love coming on the show, so thanks for having me.
Now, you've been busy, you've been traveling the world, you've been coming back, and it's been all systems go. What
Mm.
has been the business, I guess, landscape for you over, say, the last 6 months? What's been some highlights for you?
Return of the investor. That's
Oh,
what's happened. I've always been keen on working with investors, but over the years, you get to know your markets and your neighbourhood, and friends talk to friends, and they talk to friends, and so you get a lot of opportunities to work with lovely clients. But often they're home finding, so you help them on that emotional journey. So I've found over the past 5 years, I've probably had a blend that's been skewed slightly closer to home buyers, especially after investors slowed down during the credit crunch, and then Victoria had its own set of issues and disincentivized a few investors there. But the last 6 months, they're back in force, and they're all from interstate.
and where's that coming from? Why the change in flavor? Why the change in results? What's that due to?
Yeah, it's a good question because our land tax is still there, and our new property management regulations are still there. I think it really boils down to value for money. There's a real perception there that Melbourne represents great buying. And also, there's a cohort, a large cohort, that are subscribing to the mean reversion theory, whether it's right or wrong, whether they have data to back it up. There's a lot of information out there pointing towards Melbourne rebounding, and they look at ratios between our capital growth rate and other capital cities. So, for example, Sydney, that ratio is a well appreciated one. But when you look at Melbourne versus Brisbane, Melbourne versus Perth, Melbourne versus Adelaide in particular, you could argue that we're undervalued. So there are a lot of people looking at that. And then lastly, I'll say that our gross rental yields have definitely moved upwards, and markedly, because we've had really strong rental movement, partially due to losing a lot of rental stock. And we've also had pretty static value movement. So when your prices stay still and your rents go up, your yields grow. So they're all of the things. I think that trifecta probably
Love it.
explains it.
Yeah, that's fantastic. That's a great explanation. But what about the type of investors? Is it those just starting on the journey? Is it those seasoned investors, or is it a mix of everything in between?
Yeah, great question. Again, it's a mix. We've had a lot of first-time investors and a lot of smaller price point investors, arguably looking in some of the really hated markets in that lower price point. Anything under $750,000 in Melbourne has on its own piece of land. It's a really highly competitive space. And there are some reports out there that look at the demand and supply ratio and identify areas that are really bubbling along. Those are areas that have done really well. Our bottom quartile prices have held firm and grown in the face of contraction in other segments of the market. But we've also got investors from interstate who are seasoned and looking at the broader opportunity. And I've had an investor with $3.5 million for one property. So, there's appetite there to exceed that sub 750 level. I'm getting a lot of people who are circling the inner ring of Melbourne and they've got, 1.2 to 1.5 to spend. So there's something for everyone.
That's great. That is a great mix. And yeah, once again, great for the investor to come back into the market. Now talk to me about the long-term strategies around getting started early. What's obviously you work with a lot of seasoned investors and you would see some trends and some things that the usual investor doesn't get to see. Talk to me about the long-term strategies.
Sorry, James, I've just got one little issue.
Oh, good.
Um,
All right, let's go.
Apologies.
Oh, good. So talk to me about the long-term strategies and about the importance of getting started early.
The earlier you get started, the longer your runway for capital growth. And a lot of people get this bit wrong. They think when they get started, they should dunk a toe in the water and go for something that is a lower price point and a higher gross rental yield. In a perfect world, you'd look at your rental yield option last when you're approaching retirement because you don't want to be signing up for a cash flow negative property that keeps you on that treadmill at work longer than you want to be. So if you can get into a capital growth asset early, and you don't need to break the bank and do something that pushes you towards the edge of your capacity and stresses you, but if you can target a property that might be negatively geared, but it has growth drivers, then you give yourself a much longer time frame to really accrue some value there with your capital growth. And
Great.
so if you've got an investor, a young investor that can do that, do something special at the start, their equity growth will allow them to then springboard into subsequent assets as they go along. And you're restricted, obviously, you've got servicing and you've got available equity, and they have to go hand in hand. You can't have one and not the other and succeed. But when you know that you've got consistent income growth and you've also got your rental income to throw on the table there as well, then you've got a much better chance of building your wealth over that period of time when you're getting young.
And are you seeing more younger investors coming into the market, or are they more older coming back into the market? Like, where are you seeing most of those newbies coming into the market? Because obviously now, where there are many different products out there for investing and getting your toe into the water. Where do you see most of those new investors coming from?
We've had a few that have turned away from shares. They've looked at bricks and mortar, and understandable, as soon as you introduce volatility or concern about share market volatility, you'll see people pivot. You often see parents who have a positive influence on their children. They are sometimes the clients that come forward. The parents might be shouting my fee, or they might just have got their head around the education piece early. One of my young investors, a guy who's 22, has just secured a house in Melbourne's Middle Ring North and did that under his own steam. But his dad had used my services, and they've probably sat around the dining room table and chatted property for decades. So you do get to see young people coming up like that. There's a lot of information on the internet, and there's a lot of great reels, inspirational stuff for younger people too. I remember my daughter pointing out a young guy called Harley Giddings, Shout out to Harley. And she was saying, oh, is it true this guy's done this, that, and the other? And I'm like, I'm your mum and I'm right here. But, someone on your Instagram reel is having more of an impact because it's peer to peer. And I think it's great. You're seeing a lot of that. You also see older investors, mature age. Sometimes they're, doing it right in time. Other times they're leaving it really late. It's very hard to work with someone when their work runway is only another 5 years. You can
Yeah.
do it, but it's not ideal. If they can get started earlier, it's much, much better.
So true. It's amazing, isn't it? The whole peer to peer. My kids are telling me all the stuff that I need to know from TikTok and recipes I should be cooking and how to manage mindsets and all that from their TikTok accounts. Interesting.
Yeah.
Anyway, so talk to me about the kids, because that's one of the topics that I want to discuss around helping the kids in that investment journey. What
Yep.
can you share? What can you give advice around strategies to help them to get into the market? Hey guys, just a little side note here. How's it going? Are you on track this year? I know that sometimes this part of the year we can feel like we're in a bit of a grind, a bit of in the trenches. Are you on track from the original plans that you set out for the rest of this year? What I've realized is that with this time of year, we get so distracted and we've got trying to chase so many shiny balls and go down so many rabbit holes. And that's why I created a program called the 90. It's a framework that actually allows you to achieve more in 90 days than ever before. Some of the feedback that we've got from some of the people that have used the process, the 90, is that they've achieved more in 90 days than the whole previous year. So if you'd like to have the tools, have the techniques, have the framework on the 90, so you and your team can achieve more in 90 days than ever before. What it does, it impacts you of how to get clear, what you need to do, and who you need to be to show up in order to achieve the things you want to achieve over the next 90 days. Simply head over to jamesshort.com.au, click on join the waitlist, fill in your details, and one of the team members will be in touch and take you through the 90 framework. On with the show.
Financial literacy is a big one, and it doesn't just start with pocket money. It actually starts with having a really good open conversation, a bit of an open book conversation with kids about how your journey's going. You want them to see it warts and all. If they go in there with a Pollyanna view and the hot water service goes in the first month and then the tenant calls for something else, they'll think it's a really awful idea. But when they've seen the ups and the downs and the long-term benefit of it, it's far better. But I will say to parents or even aspiring parents, you don't need to shout your kids a property to get them into property. And you don't need to feel like you're failing them if you can't. It's not about gifting them money. There are ways to gift money and there are ways to gift opportunity. I'll talk about all of those. There's a bit of a spectrum. The most assertive way of getting your kids into property is literally to buy them something. And I think you take away their dream when you do that. I had parents that didn't do that for me. They educated us and they loved us, and we bought our own places. And there's a huge degree of pride with that, and I did it myself. I don't need to feel like I had someone, kicking that goal for me. The next thing that parents can do is to gift an amount of money. Sometimes I have clients that might be spending inheritance early, so the parents want to see them benefit and enjoy it while they're alive to witness it. Sometimes you see it might be an inheritance from a late grandparent and the parents ensure that it goes to the grandchildren rather than the parents. And that all comes down to how much money you need and how you're feeling about that gift. The popular one, which a lot of people can afford to do because they've got a family home, is help their children with equity. So you're not actually giving them money, you're giving them an opportunity. What you're really giving them is a portion of the loan. So rather than saving 10% or 20% deposit and then borrowing 80%, they're using your 20% plus 5 for the stamp duty, and then they're borrowing 80. And it's not for everyone, and some parents get very nervous about it. But it's an equity loan. It's a parental guarantee, a family pledge, whatever you want to call it. They've got lots of names. What it really means is the parents are putting a portion of their property on the line to enable their kids to use that equity. And I think that's an enormous gift when it's for the right reason and the recipient understands the gift, because you need to make sure that you've got a responsible child carrying that. There is always that risk that if repayments aren't made. The bank can move in and make sure they get their money. Now, the way that it works is if a parent does agree to this, they usually have to get legal advice. It's a requirement of the lenders. So the solicitor will talk them through all of that anyway. And it is true that if the child defaults and the bank makes the decision to sell the property, the parents will get their money back first. But it's not a nice process to go through. So that one, there's lots of caveats associated with that. Moving down the ladder, there might be an opportunity for parents to pay for a buyer's agent or pay for an education piece for their child, or it might just be that they're offering, lots of moral support. They're going out with their child looking at property, or they're offering their thoughts when they're asked for it. So it doesn't just start and stop at giving money. You can provide your kids with magazine subscriptions or learning subscriptions, whatever it might be. There's ways that we can take our kids on this property journey. I know personally I've got a handy husband, so our children are lucky because if they need help with renovating, he's very quick to put on his tools belt. But I went Harveys with my stepson, so we bought a property when he turned 21. I put in the 10% deposit, and I was fortunate enough to get a 90 LVR loan without LMI. And he put in the hard yards. He had to do some of the renovation work. So we worked it out that way. But there's lots of ways you can do it.
That's so good. And it's so nice to paint the picture where you don't have to physically go and buy them a property. It's just like there are so many different ways in between, from education to even having those conversations around the dinner table of what to expect and sharing your own personal journey. So that's so great to get that scope, which is great. Where do you think parents fall down in relation to that education piece when it's trying to have those conversations to the children?
I think that you've got to make sure that you take them with you. If they're resisting and you're docking their pay and stopping them going out and drinking with their mates, you might be creating a rod for your own back, and they could have a negative association with someone with Big Brother trying to take their money. Also, I think when parents are happy to help their kids and they do want to put in money, if there are too many strings attached or if they're taking control of the project too much, I've seen parents influencing really hard to have their kids around the corner or have their kids in a property that might be their, place to live one day in the future. It's a really hard assignment when the parent's taking too much of a leading hand. And ultimately, there's no point purchasing a property for someone to live in, if that's the case, when they're not going to have a very long tenure. A short tenure means that you'll either have to convert the property into an investment property, and it might not be a great investment. If you've chosen it for owner-occupier use and you've ignored investment requirements and then you're wanting to pivot, that could be messy. Also, if your child doesn't want it and they want the money for a different property or a different whatever, you've just done your stamp duty or lost their opportunity to have subsidised stamp duty. So they have to be, on board.
That's great. Great outline, great advice. Super appreciate it. I remember when we moved up to the Northern Rivers, our kids went to every single open. And it's like, oh, not another one, not another one.
They
And my
hate it.
son kept that whole folder of all the different open homes that we went to. So he still got it. And we flicked through. It's like, oh, remember that one? So yeah, once again, it's good to take them on that journey. Now that opens up the conversation around off-market properties. Now, give me what that means to you and where is it miscommunicated out into the market?
A lot of people assume that an off-market property isn't online at all. And in a lot of cases, off-market's a really blurry concept, and there's lots of different types of off-markets. Sometimes people will just do an off-market transact. Well, they'll advertise off-market because they want to avoid expensive fees on the major portals. So the agency might have their own portal and the property is actually online. It's just not on the biggies. Or it might be a pre-market, a property that is destined to go to market. They've already booked in a potential sale date or auction date, and the agents are happy to float it around early and call it an off-market and see if they get an offer that blows them out of the water. And that can happen if someone's desperate enough, if they've missed out enough, or if they haven't bothered to do their analysis and they just think off market means opportunity, they could be paying a real premium for that opportunity. But in short, an off-market property is one that's not advertised on the market. Now, I separate off markets into two categories, James. There's a situational off market, which means it's off market for a reason. There's a certain situation that needs it to be sold, and they haven't got the opportunity to go on market. And then there's an opportunistic off market, and that's the vendor that isn't really committed to selling, or they've got an unreasonable expectation. And they might get that price if someone's silly enough to pay it. It might be a property that's so compromised it's not likely to attract lots and lots of buyers, or it could just be a silly price tag. So opportunistic off markets and situational off markets, they're two very different ones. And a good example of a situational off market is someone that, let's say they're building a house on land, or they're constructing a home, and they need to sell their house in order to free up money for their progress payments, but they need a roof over their head. If they sell to an investor or to a flexible owner-occupier who's happy to give them a period of time to lease back their own home with a flexible settlement, that's a great outcome for them. In fact, it's worth money. Economically, that's something that they'd be prepared to fund with their expectations on sale price. So instead of going to market and having, a great sales campaign or an auction and getting X dollars, they might get, X minus $50,000 because it's quirky and it's not a settlement arrangement that works for everyone, but it gives them the outcome that they want. So that's one example. Others might be investors who are offloading properties and they don't want to upset the tenant, or the tenant's not playing ball with giving access and keeping the property looking nice. So there are lots of reasons for situational off markets, and we certainly get a few of those.
That's fantastic, because it's really, once again, it's some situations are quite delicate. Some, need to be communicated differently, and obviously have different expectations, both, for the vendors and potentially the purchasers as well. Really appreciate it. What's coming up for you in the next 6 to 12 months? What are some of the exciting projects that you're looking forward to?
Oh, it's a good question. I think if we can get through spring, I'm bracing because
Yep.
we've got talk about interest rate cuts. We're getting a lot of inquiry, not just from investors, but owner occupiers. And a lot of buyers are really nervous about the impact of a rate cut or a double rate cut. They're scared that the market will fly away. So they're reaching out for help. And I know that, like any spring, we'll have a lot of transactions and a lot of responsibility to help our clients through that. So at the moment, I'm just looking to get through that. But I've had a big 12 months. It's been a really busy time. I've written a book with Pete Wargent just over a year ago. We still have a bit of fun with that. Every now and then I'll have an interview with him, or we'll get an opportunity to present somewhere. I'm on the board of directors with Pippa, so we've got a conference coming up. I'm still very active and enjoying my Reba community. So, it's never a dull
Lots
day.
happening. Lots
I'll stay
happening.
busy.
So
Yeah.
share us about where can people get the book, and what is the book about?
Okay, it's called The Buy Right Approach to Property Investing, and we're on the shelves in the airports, and we're also online. It's a book that's not just for a sophisticated investor who needs more detail and more of the technical element. It's also for someone who's getting started and thinking strategically about what their plan looks like, because every investor's plan is very different. You've got a certain amount of runway, as I call it. You've got a certain amount of time and effort and expertise in being hands-on. Some people just want to set and forget, others want to do improving. But my theory is very aligned with Pete's as well. It's all about holding for the long term. So making a long-term decision, not looking at short, fast gains. It's not really an asset class that's easy to achieve that. So yeah, the book can be purchased online or on the shelves, and it really does address all of the elements. And I've used a lot of real life examples as well to illustrate my points and to, show a bit of vulnerability. Property investing is not straightforward. Everyone's journey is different, and the unforeseen can happen, and it's how you deal with it.
So true. So we'll have all those details in our show notes to where to get the book. And how else can the audience get in contact with you and follow your journey?
I'm online. Cate Bakos is my name, Kate with a C. So if you Google Cate Bakos, or if you jump onto the website, catebakos.com.au, you can find us there. And I do a regular Sunday blog every week. I write about something topical, and I put that up there in our notes as well.
Fantastic. We'll get sure to share those as well. Kate, really appreciate your time, your energy, and your expertise. Thank you once again for being on the show.
Oh, absolute pleasure. Thanks for asking me.